Okay, guys, so let's talk about an actual trade, just visualize it on a chart, see where we are with this. So, how's it work? So let's say we look at crude oil, look at the chart, we think, you know what, this looks like it's going higher to me. I think I'm going to buy this. I want to express a kind of bullish opinion on this thing. I want to make some money if this goes higher. I want to put my money where my mouth is, put some risk on the table, and express this trade. So to do that, we're going to buy. We're going to go long. So we think it's going to go up. We would buy or go long at, let's say the price at the moment is $36. So we go long at $36. And fortunately for us, a couple of weeks later, the price moves up and we say, brilliant, that's exactly what we expected. We bought here around at 36. It's now a couple of weeks later, it's now at 48. Fantastic. Let's close the position. So we go into the platform and we sell the same amount of CFDs we bought to give ourselves that neutral position. And we've got a $12 profit times our position size. So the value of our initial position, the value of the position that we sold, the value of the crude oil when we sold times our position size, and then the contract for difference is basically saying the broker is going to pay us the difference in valuation because we've gone long. So let's look at it on the flip side. Let's say we think, you know what, this thing now is going down. I want to try and express a little bit of a trade here. What can I do? I've sold my crude oil long at 48. It's now above 50. This looks a bit high to me. I think it's going to roll over. Okay, yeah, I can express that with a short trade. Right. So what do? So I think it's going to go down. I can sell it, or I can go short specifically. So again, I am selling something I do not own, but it doesn't matter because lots of things going right along behind the scenes to allow us to do that. And with the CFD, ultimately, again, all we're saying is when we're going short, we're saying, you know what, Mr. Broker, you can pay me the difference. If this thing goes lower than it is when I've sold it, you pay me the difference. If it goes higher, I'll pay you the difference. Deal done. And that's obviously all automated very quickly. So we go short $50. Price moves down to $40, and we think, you know what, thanks very much. Let's take another $10 out of this market. We close our position. To do that, we buy the same amount that we have just sold a few weeks earlier to give us a neutral exposure, neutral position, and then we will settle up. So we'll look at the valuation of the position when we sold it, the valuation of the position when we bought to cover, and then the difference in this case is going to be a negative value, and which is what we want because we've gone short and we've agreed that with the broker. So there we go. Broker says thanks very much. There you go. There's $10 multiplied by a position size, and that is ultimately how we make money. And obviously, if it had gone against us, we'd have had to cover that loss as agreed in the CFD. So what does it cost to trade? Let's have a look at some equities. So a CFD broker is going to offer you, he or she is going to offer you two prices. It's going to be a buy price and a sell price. And we kind of alluded to that earlier with the little screen drawing pen we put up there. And the difference between those two is called the spread. Now, the spread is fixed. It's not fixed. It's basically set by and decided by the underlying market or the exchange that you're trading on. So this is, again, when it comes down to what's the underlying. We talked about what's the underlying. It's the asset that your CFD is ultimately based on. So whatever that spread is in the exchange, let's say you're trading Apple, which is on the NASDAQ. Let's say you're trading US Steel on the New York Stock Exchange. Let's say you're trading Tesco's on the London Stock Exchange. Let's say you're trading DAX on Eurex. Those exchanges that actually hold the underlying instrument will have buy and sell orders, and that will give you the spread. So your CFD is ultimately based on the spread. So that's your first cost. The second cost is going to be a commission that is added to your trade price. Now this depends on which broker you're using, but usually it's going to be something like 0.1%. You don't really want to be paying more than that. If you're paying more than that, then it may be time to look for somebody else, because especially if you're short-term trading, this kind of thing can add up quite quickly. And many years ago when I was trading and opened a CFD account, my first CFD account I think was in 2002 or 2003, around that sort of time. It was really expensive to trade. If you were short-term trading, you had to be on some really volatile stuff or really bang on the money, or the whole thing would just catch up with you. It would end up, costing you a fortune. So you've got to be careful about your commission. Obviously, the longer you're holding the position, the less of a concern it is. And now, one advantage, of course, with a CFD that we didn't mention earlier, but of course is very, very important, is the fact you do not have to pay stamp duty on UK stocks, or UK shares, should I say. If you're buying shares directly via a broker, you have to pay stamp duty. With CFD, you don't. So even though there's a commission, and you might say, well, buying shares, it's only cost me £5 for a trade, blah, blah. Yes, that's fine, but you do have to pay stamp duty on that. So ultimately, if you're short-term trading, then CFDs are definitely the way to go. So if we look at this price quote here, we've got this mythical stock, whatever it may be. The sell price is 380.25. The buy price is 381.25. And the spread, the difference between the two, is 1 point or 1 penny, whatever it may be, 1 cent when we're looking at. And then you've got your commission to pay on top of that. So that's an equity. Let's have a look at FX or an index. So again, the broker is going to offer you a buy and a sell price. Now, the underlying may well be there, but the broker may create a kind of fixed spread to get more business from clients. Even though the underlying might be adjusted, he may well swallow the spread sometimes just because he likes the two-way flow. And some of the more popular instruments, it's a good headline thing to offer. So it's great for us traders if someone's offering a decent tight spread on some of the things you like to trade, like FTSE, the DAX, NASDAQ, Dow, whatever it may be. That's great. It's great for us as traders. So again, difference is the spread. But this time, there's generally, with most of the brokers these days, there's no commission to pay on this, because they wrap the commission into the spread, because they find it easier, and again, it's more attractive for clients who can see this. They know their cost. So let's say your FTSE price quote is 6047 to buy, 6046 to sell. That's basically it. You're buying at 6047, however many CFDs you're buying. You're selling at 6046. The difference is that there's no commission. It's all wrapped into the spread. So because it's easy for them to do it, because you can visualize it easier. They understand the value of it. They do it for certain reasons, but you've got to just keep an eye on that. It changes from broker to broker. But most brokers now will wrap an index or a currency forex quote. They'll wrap it all up in the spread, as opposed to giving you a separate commission. Whereas equities, you'll have to pay a commission on